Rule number 1. Master the art of investing for passive income. What if the secret to financial freedom is in your hands? Imagine confidently investing on your own, without relying on brokers or middlemen. Phil Town's rule number 1 reveals the proven strategies that turn everyday people into successful investors, offering you the blueprint for creating a comfortable passive income. In this audiobook, you'll discover how to build lasting wealth by following the powerful principles in rule number 1, a philosophy pioneered by Phil Town. Whether you're a novice investor or someone looking to refine your strategies, this guide will show you how to make informed, calculated decisions that bring financial stability and long-term success. Learn why trusting your instincts, valuing the right business opportunities, and understanding the dynamics of the market can make you a confident and independent investor. Focus points. The power of rule number 1. Unlock the essential investing rule that could make you a successful investor without intermediaries. Self-sufficiency in investing. Why you don't need brokers or middlemen to succeed in the investment world. Selecting the right company. How to choose the right business to invest in based on your interests and values. The secret to reliable shares. Understanding what makes certain shares trustworthy and how to identify them. Level 5 leadership. Learn about the leadership qualities that drive successful companies and how they impact your investments. Fact-based decisions. The importance of using calculations and data to guide your investment choices. Prepare for all scenarios. How to stay flexible and respond to market changes with confidence. Learning outcomes. Understand the philosophy behind rule number 1 and how to apply it to your investment strategy. Learn how to assess a company's potential, security, and leadership for smart investment decisions. Gain the tools to make confident, fact-based decisions without relying on intermediaries. Discover how to create a personalized investment plan that aligns with your interests and values. Build a strategy that prepares you for any market condition and ensures consistent passive income. By the end of this audiobook, you'll be ready to take control of your investments and build wealth in a way that fits your lifestyle and goals. Focus point 1. Master rule number 1 to become a successful investor. Many young people face significant challenges when it comes to managing their finances, including saving money and paying off debts. Without proper financial literacy, it can feel overwhelming, and the concept of investing often remains a mystery. However, learning how to invest wisely is one of the best ways to ensure a secure and comfortable retirement, offering a way to build wealth without constant worry about your financial future. In this section, we dive into rule number 1, a strategy designed to help you achieve high returns while minimizing risk. This powerful approach was developed by Benjamin Graham, a renowned professor at Columbia University, and later adopted by Warren Buffett, one of the most successful investors of all time. Rule number 1 centers around the simple but profound principle: don't lose money. As Warren Buffett wisely states, there are only 2 rules of investing. Rule number 1, don't lose money, and rule number 2, don't forget rule number 1. Unfortunately, there are several myths surrounding investing that often discourage people from even starting. Myth 1. To manage investments, you need to be an economic genius or have a deep understanding of financial markets. Myth 2. It's impossible to beat the market and make significant profits. Myth 3. You must spread your investments across multiple stocks to succeed. Rule number 1 directly challenges all of these misconceptions. Investing isn't about expertise. Anyone, even with no financial background, can successfully invest with just 15 minutes of effort per week. The market can be outsmarted. With the right strategy, it's possible to earn 15% or more in returns, far exceeding the typical market average. You don't need multiple investments. The key is to buy undervalued assets at a significant discount, buying $1 for 50 cents, and selling them when their value rises to fair market price. Repeat this process, and you'll accumulate wealth over time. The beauty of rule number 1 is that it's accessible to anyone with a computer and a willingness to learn. You don't need a financial degree to start building wealth and creating a passive income stream. In the following sections, we'll debunk these common investment myths and show how ordinary people without specialized knowledge or a background in finance, can grow their money, create financial security, and set themselves up for a stress-free retirement. Stick with us as we reveal how you can use rule number 1 to take control of your financial future. Focus point 2. You want to do well, do it yourself. When it comes to investing, many people turn to safe methods like bonds, which promise a guaranteed 4% return. While this may seem like a secure path to building wealth, it's a slow and inefficient approach. Over the course of 18 years, you might double your money, but due to inflation and rising prices, that doubled amount may not have the purchasing power you need. Yet, despite this, many continue to rely on such cautious investments, believing that smaller, more controlled amounts are less likely to result in significant losses. Similarly, many people invest through mutual funds, where money from several contributors is pooled together and managed by brokers. The most common strategy here is dollar cost averaging, DCA, which involves regularly investing a set amount of money, regardless of the market conditions. The idea behind this approach is to spread out your investment over time, reducing the risk of buying at a market peak. However, the strategy ignores market opportunities and doesn't allow for optimal timing of purchases. Over the long term, DCA averages out the ups and downs of the market, but it's not necessarily the best way to maximize profits. In fact, mutual funds often offer less security than investing on your own. By entrusting a fund manager with your money, you're at their mercy, subject to their decisions, and unfortunately, the risk of scams or poor management. On the other hand, when you invest independently, you have the flexibility to act when others hesitate. You can buy stocks when others are too fearful to invest and sell when the market is overheated, capitalizing on opportunities that fund managers may miss due to their conservative approach. There's a common belief that substantial profits require high risk or unpredictability. But let's challenge that notion. Think of learning how to drive a car. When you're a beginner, you move slowly and cautiously, trying to avoid making mistakes. Yet even at this careful pace, you're still at risk of accidents. On the other hand, an experienced driver, who understands how the car operates, can navigate the road with confidence at higher speeds without increasing the risk. The same principle applies to investing. Moving quickly or decisively doesn't necessarily increase risk if you know what you're doing. In investing, as in driving, experience and skill are what ultimately allow you to navigate uncertainty with ease. By learning the fundamentals and understanding how to manage your investments independently, you gain control over your financial future and reduce the unnecessary risks that come from relying on others. So if you want to do well, take charge of your investments and manage them yourself. Focus point 3. Choose a business that suits your interests and values. Diversification is a common investment strategy, where investors spread their money across different financial instruments, sectors, and even countries to reduce risk. The idea is that if one investment fails, others will provide a cushion. However, with rule number 1, diversification isn't necessary. Instead, you focus on investing in businesses that align with your interests and values. This focused approach allows you to engage with companies you're passionate about, while still seeking to make profitable decisions. Think of investing as planting seeds in a garden. If you carefully choose your seeds and nurture them, you will harvest the rewards later. Similarly, investing in businesses that you understand and care about means you're more likely to make informed, thoughtful decisions that lead to successful outcomes. As Phil Town puts it, imagine that you'll reap what you sow. To choose where to invest, rule number 1 encourages you to follow 3 key criteria. You understand and care about the business. Invest in businesses that you genuinely find interesting and understand well. This allows you to make informed decisions and stay engaged in your investments. Financial stability and predictability. Look for businesses that are financially stable and have a predictable future. This stability gives you confidence that your investment will grow without unnecessary surprises. Quality management. Invest in companies with a strong management team. The people running the business should be passionate, skilled, and dedicated to the company's success. According to rule number 1, an investor should focus on finding the right business and purchasing it at a favorable price. The key steps are simple. Choose a good business that aligns with your interests and values. Determine its true value through careful research. Buy it at half price, ensuring you have a margin of safety. Hold on to your investment until it yields returns. To help determine which businesses to invest in, Rule number 1 introduces the 4M's principle, meaning, moat, management, and margin of safety. Meaning, invest in a business that you believe in so much that you'd be comfortable depending on it as your sole source of income for life. Moat. This refers to the company's ability to protect itself from competition, much like a moat protects a castle. Look for businesses that are safe, secure, and have a competitive edge. Management. Ensure the company's leadership is passionate and capable. Good management is key to navigating challenges and growing the business. Margin of safety. Always buy stocks at a significant discount to their true value, ensuring that even if the market shifts, you're still positioned to profit. When evaluating a business, ask yourself if it meets these 4 principles. The more characteristics that align with these criteria, the more likely it is that your investment will be successful. Another critical point to consider when choosing a business is the 10-to-10 rule. This rule suggests that if you're not willing to hold on to the business for 10 years, you shouldn't even spend 10 minutes considering it. This mindset encourages long-term thinking, which is essential for developing the discipline required to be a successful investor. By focusing on businesses that fit your interests, values, and long-term goals, you'll not only make smarter investment decisions, but also develop the patience and commitment necessary to thrive as an investor. Focus point 4. An investor must consider the prospect and security. The quickest and most reliable way to choose a business to invest in is to start by analyzing what you regularly spend money on. Think about the services or products you rely on, the companies you interact with most often, and where you make frequent purchases. These everyday decisions can help you identify potential businesses to invest in. From there, your task is to evaluate these options and select the most reliable ones. A key factor in this evaluation is determining whether the business has a wide moat. A wide moat refers to the protective barrier a business has that ensures its longevity and market dominance. When a business has a wide moat, its future is more predictable and secure, which significantly reduces the risk for investors. If you're confident that a business will continue to thrive and grow for the next 20 years, it likely has a strong moat. Businesses with a wide moat are typically resilient to inflation, economic crises, and market fluctuations. They can raise prices without losing customers because their product or service is in high demand and indispensable. These companies often have a unique advantage that sets them apart from competitors, making them stand out in the market. Some notable examples of companies with wide moats include Coca-Cola, Disney, and Apple. These businesses have established such strong brands and reputations that most people recognize them and continue to buy from them, even during economic downturns. Their wide moat allows them to maintain market dominance and command premium prices. There are 5 key factors that contribute to a wide moat. Brand recognition. Companies with a well-established, trusted name can charge higher prices because consumers are willing to pay for the value associated with the brand. For example, Nike is known for its premium athletic wear and loyal customer base. Intellectual property. A business that owns patents or trade secrets that protect its product from replication holds a significant advantage. Pfizer, for example, holds patents on many of its life-saving medications, preventing competitors from copying their products. Industry control. Companies that dominate an entire sector and offer essential services that other businesses rely on can charge for access to their services. For instance, large advertising agencies control much of the market and can set the terms for other businesses. Essential services. Companies that provide services or products so integral to daily life that consumers can't do without them, such as Microsoft, are protected by their utility. Without their services, both businesses and individuals would struggle to function effectively. Competitive pricing. Businesses that consistently offer lower prices than their competitors, like Walmart, can create a competitive edge that keeps customers returning despite the presence of other options. The more of these characteristics a business possesses, the more likely it is to be a secure and promising investment. Did you know? The Coca-Cola recipe is one of the best-kept secrets in the world. Since its invention by John Pemberton in 1886, the recipe has been securely stored in a safety deposit box, ensuring that competitors cannot replicate it. This secrecy is part of what has helped Coca-Cola maintain its wide moat over the years. Focus point 5. Rely on calculations and facts to make accurate decisions. Investing based on intuition is risky, and to make sound investment choices, an investor must rely on facts and calculations. According to rule number 1, to assess the presence of a moat and evaluate a company's financial health, it's essential to analyze the Big 5 numbers, which provide a comprehensive picture of the company's financial state. These numbers help investors make informed, data-driven decisions rather than relying on gut feelings or guesses. The Big 5 numbers. Return on investment capital (ROIC). ROIC measures a company's productivity and profitability. It tells you how effectively a company is using its capital to generate profit. Formula: ROIC equals net income share capital / text ROIC equals / frac / text net income / text share capital. ROIC equals share capital net income. Ideal: a company with an average ROIC of 10% or more per year is considered profitable and efficient. Sales growth rate. This metric looks at the sales figures over the past decade to determine the growth trajectory. Companies with consistent sales growth indicate healthy demand for their products and services, which reflects a stable or expanding business model. Analyzing a sales growth rate helps predict whether a company is on a sustainable growth path. Earnings per share, EPS. EPS measures the profitability of a company on a per-share basis, reflecting how much profit a company generates for each share of common stock. Formula: EPS equals net income minus preferred dividend shares outstanding / text EPS equals / frac / text net income / text preferred dividends / text shares outstanding. EPS equals shares outstanding net income minus preferred dividends. A higher EPS is a good indicator that the company is efficient at generating profits for its shareholders. Book value per share, BVPS. BVPS is a measure of a company's equity relative to its shares. It helps determine the underlying value of the company based on its assets and liabilities. Formula: BVPS equals equity shares outstanding / text BVPS equals / frac / text equity / text shares outstanding. BVPS equals shares outstanding equity. BVPS indicates the value of a company's shares based on its book value, and a higher BVPS suggests a company is better capitalized. Free cash flow, FCF. FCF is the cash a company generates after all expenses, taxes, interest, and capital expenditures have been accounted for. It represents the money that can be returned to investors or reinvested in the company. Formula: FCF equals operating cash flow minus capital expenditures / text FCF equals / text operating cash flow / text capital expenditures. FCF equals operating cash flow minus capital expenditures. Companies with a healthy FCF can use it to pay dividends, buy back shares, or reinvest in their business without financial strain. Key takeaways from the Big 5 numbers. All of these metrics should exceed 10% per year over the past decade for a company to be considered a strong candidate for investment. By using online calculators or financial websites such as MSN Money, you can easily calculate and track these metrics for any company. It's important to assess the capital growth rate over 1, 5, and 10 years, as it helps predict the company's future performance and its ability to generate profits. A greater capital growth means the company is in a strong position to create new products, expand its offerings, and continue to perform well in the market. The margin of safety, MOS. The margin of safety, MOS, is a crucial factor in minimizing risk. The MOS represents the difference between the price you pay for an asset and its intrinsic value, acting as a cushion in case things go wrong. To make a safe investment, You need to ensure that the price you're paying for a company's stock is half of its fair retail price. If you can't acquire shares at such a favorable price, it's better not to invest in that business. The MOS protects you from potential losses by ensuring that you're buying an asset at a discount to its intrinsic value, reducing the downside risk. By relying on these financial calculations and focusing on facts rather than intuition, you can make more accurate, rational investment decisions. A business with high ROIC, consistent sales growth, strong EPS, high BVPS, and healthy FCF is likely a reliable investment. Adding the margin of safety ensures that you're purchasing assets at a fair price, thus maximizing your chances of profitability while minimizing risk. Focus point 6. Be prepared for any course of events and act accordingly. The success of any business depends significantly on the leadership at the top. The most successful companies are often led by what are called Level 5 leaders, who possess two crucial characteristics. Purposefulness. They focus on long-term goals, strategy, and the company's mission. Orientation to the owner. They prioritize the interests of shareholders and stakeholders, ensuring that the company thrives financially while aligning with its core values. Characteristics of a Level 5 leader. A Level 5 leader, such as Bill Gates, combines humility and ambition in equal measure. They do not lead to boost their ego, but rather to drive the company toward its greater purpose. These leaders set the tone for the entire organization, communicate the company's values, and create a strategy that involves everyone in the company, ensuring long-term success. In contrast to leaders who prioritize short-term gains or their personal image, a Level 5 leader's primary concern is the company's health, its growth, and the well-being of its employees and shareholders. This long-term vision is crucial for an investor, as the stability and direction of a company are largely determined by its leadership. The role of CEO in investing decisions. Before investing in a business, it's essential to research the CEO. A good decision is to understand their leadership style, vision, and transparency with shareholders. One of the best ways to do this is by reviewing letters to shareholders. These letters are typically published annually on the company's website and provide valuable insights into the company's current status, successes, challenges, and future plans. Transparency and openness. A great leader should openly discuss the company's challenges and provide clear strategies to overcome them. If the CEO avoids explaining losses or doesn't address the strategy for resolving issues, this could be a red flag. The absence of transparency may signal poor leadership, making the company less attractive for investment. A Level 5 leader is a key indicator of a company's potential for long-term success. If the CEO is committed to the company's mission, has a solid long-term strategy, and is open and honest with investors, the company is likely in good hands. What to do if your investment faces challenges? Sometimes, despite doing everything right, investments can take unexpected turns. The price of a company's shares might suddenly drop, or the company might no longer align with your criteria. In these cases, don't panic. Here are some strategies to handle these situations. Wait it out. If the company's long-term fundamentals remain strong, a temporary drop in stock price can often be recovered over time. Resist the urge to sell in a panic, as markets can fluctuate, and such volatility may just be a temporary phase. Focus on your portfolio. When one investment underperforms, it's important to look at your other investments. Diversifying your portfolio helps reduce the impact of a single loss. This way, you can focus on the overall performance rather than getting fixated on one stock. Reevaluate the business. If a company's stock price drops significantly, consider if it still meets your criteria. Have its fundamentals changed? If it no longer fits your strategy or objectives, it might be time to sell. But always base this decision on facts, not emotions. Monitoring critical events. Use tools like MACD, Moving Average Convergence Divergence, and other market tracking programs to stay updated on critical events within the company. These tools can signal when significant investors buy or sell shares, or when other major shifts occur within the business. The power of patience and long-term thinking. Remember, ideally, You never have to sell your shares because the business is continually making money. If you've invested in companies with strong fundamentals, transparent leadership, and a wide moat, your shares should continue to generate returns over time. However, being prepared for unforeseen events and remaining calm during market fluctuations is key. If a company's shares suddenly drop, don't rush to sell or panic. Focus on the bigger picture and stick to your long-term investment strategy. This disciplined approach will help you avoid losses and stay aligned with rule number 1, ensuring you don't lose money while working toward financial success. In summary, always invest with confidence in companies that are led by strong, transparent leaders and that have a solid long-term vision. When challenges arise, stay patient, trust in your research, and remain focused on the bigger picture. Conclusion: the key to securing your financial future lies in understanding the principles of investing and practicing rule number 1. By adopting a disciplined approach to investing and focusing on value, you can achieve financial independence without the need for intermediaries. Rule number 1 emphasizes not losing money, which is more crucial than chasing risky profits. If you follow this principle, success in investing will come naturally. The goal is simple: buy $1 for 50 cents. This means finding undervalued businesses that you can purchase at a price lower than their true worth. You don't need to be a genius or a math expert to execute this strategy, but you do need to be methodical and strategic. Utilize formulas and strategies that assess the health and value of a business to ensure you're making informed decisions. To achieve long-term success, you must approach investing with enthusiasm and a curious mindset, as an explorer would. Look for businesses you believe in and ensure they offer you consistent returns. However, always remain precise in your calculations, stick to your plan, and avoid impulsive decisions. Investing requires patience and a cool head, especially when faced with setbacks or emotional temptations to sell or panic. With persistence and methodical thinking, you'll develop the confidence to navigate the market and ultimately become an independent and successful investor. Remember, not losing money is the key to long-term success. By avoiding significant losses, you'll be in a better position to generate substantial returns over time. This is where your focus on value and smart decisions will set you apart from others who may chase short-term gains. To deepen your understanding of investing, explore the following. Watch the movie Margin Call, 2011. A drama about the financial crisis of 2007 to 2008. It offers an insightful look into the world of investment banks and the early signs of economic instability. Explore the YouTube channel Wealth Hacker, which covers economic news and investing strategies. You can learn about passive income, budgeting methods, and how to save money for long-term financial growth. Read One Up on Wall Street by Peter Lynch. This book provides timeless advice on how to use your existing knowledge and interests to find promising investments, straight from one of the most successful mutual fund managers of all time. Thank you for listening to this audiobook on rule number 1, investing principles. Let's take a moment to summarize the key focus points discussed, which are essential for making smart, value-based investment decisions. The importance of choosing the right business. Invest in companies that you understand and are passionate about. Ensure they are financially stable, predictable, and led by strong professional management. The 4 M's principle. Evaluate businesses based on, meaning, can you rely on this business for your entire financial future? Moat. Does the company have a competitive edge, a strong position in its market? Management. Are the leaders transparent, focused on the long term, and dedicated to shareholder interests? Margin of safety. Can you buy shares at a significant discount to their true value? Key financial indicators. Use the big 5 numbers: return on investment capital ROIC, sales growth rate, earnings per share, EPS, book value per share, BVPS, and free cash flow, FCF. To analyze a company's financial health. The 10-to-10 rule. Only invest in companies that you're willing to hold for the long term, at least 10 years. This reflects a commitment to consistent, stable growth. Prepare for market fluctuations. Don't panic during price drops. Stick to your plan and avoid emotional decisions. Sometimes, a company's long-term prospects can still be strong even during temporary downturns. Recommendations: focus on value, not trend. Instead of chasing the latest investment trends, concentrate on finding businesses with long-term potential and a solid financial foundation. Be methodical, not impulsive. Stay calm, stick to your strategy, and evaluate opportunities based on facts and calculations, not emotions. Use the Big 5 metrics. Regularly assess your investments using key financial indicators to ensure they align with your long-term goals. The principles shared in this audiobook can help you become a more confident, strategic investor. By focusing on rule number 1, not losing money, you can secure a financial future that is stable and prosperous. This approach will help you filter out noise and make decisions that are rooted in solid data and long-term growth potential. Thank you for your time and attention throughout this audiobook. I hope the insights shared will empower you to take action and make informed investment decisions. If you found this content valuable, please like, subscribe, and share this audiobook with others who may benefit. Remember, investing in your education is the best way to ensure a successful future. And just like with language learning, the more you listen, the better you speak. The more you engage with these investment strategies, the more confident and successful you'll become as an investor. Thanks again for listening, and happy investing!